Good afternoon. I'm Jim Kelly, Director of the Gabelli Center for Global Security Analysis and Senior Lecturer in Finance and Economics at Fordham. It's my pleasure to welcome you all today on behalf of our partners, the Museum of American Finance and the CFA Society of New York. Our goal is to bring you renowned experts from many different fields to speak on topics and issues that are relevant to you, the economy, and the market. Today's webinar features distinguished banker, executive, and historian Paolo Zanoni as he discusses his new book, Money and Promises: 7 Deals That Changed the World. After his talk, Q&A will be led by David Cowan, President of the Museum of American Finance, and Paul Johnston, Executive Director of the Gabelli Center. Please submit your questions at any time through the tab at the bottom of your screen. All attendees at today's event will be offered a free digital copy of the book with information coming to you after the event. Now I'd like to turn it over to David Cowan, who will introduce our speaker.
Thank you, Jim. Great to be back. One of the blurbs from our author's book reads as follows: through rich storytelling, Paolo sheds new light on the complete interdependence of banks and states under the guise of debt issuance. The result is a thoroughly enjoyable and readable book about the 500-year history of worldwide banking. Well, the author of the blurb is me, because I had the pleasure of seeing a draft copy of the book about a year ago for my review and comments, which, as you heard, are quite favorable, and therefore I'm particularly looking forward to today's presentation. Paolo has combed the archives, including finding new evidence for us respecting Italian banking. And one particular chapter I enjoyed was analyzing the case of the Bolsheviks, which is something most of us, including me, don't know much about. We'll be adapting chapter 6 of the book, entitled American Dream, into an article in the summer issue of our own magazine, Financial History. Paolo is Executive Deputy Chairman of the Board of Prada, President of Prada Holdings, and International Advisor to the Executive Office of Goldman Sachs International. He's also a member of the Advisory Board of the Jackson Institute and Center for International Finance at Yale University. His former positions over a very long and distinguished career in global finance, including a partner at Goldman Sachs, Chairman of the Board of Persimmon, President of Fiat USSR, and President of Fiat USA. It's my pleasure to turn it over now to Paolo Zanoni.
Okay. Thank you, David, and thank you to everyone. It's a pleasure to be here to talk about my book. It took me, I was in finance, I still am to some extent, but I was in finance for a long time. But it took me quite a long time also to realize that money is debt, debt backed by debt, and modern money is a debt of banks. And that through several centuries, the debts of banks have become the currency of nations. I am sure is something that you are totally familiar with. It probably took you less time to realize it, but it took me a long time. But what I found out is that this simple fact helps explaining a peculiar feature of modern nation and the modern economy. And the peculiar feature is that banks get in trouble often, very often, and when they do, government bails them out anytime and anywhere. I have found, doing the research of my books, many instances of banks getting in trouble and governments bailing them out from, I would say, probably the 15th century and all over and across the world. And banks get into, if you think about what I said at the beginning, that money is debt, backed by debt, it's clear why banks get in trouble. They get in trouble because bankers are always debtors. They owe to their clients, they owe to their partners, and they owe to their competitors. And businesses that where the owners are always in debt cannot be very stable because they are in a situation in which their assets are also debt. They are the debt of someone else. It's very difficult to believe that a business that has this structure is going to be a stable business. Actually, Martin Wolf, the economic commentator of the Financial Times, has gone to the lengths of saying that banks have been engineered to fail. And when they do, which I repeat is very often, the state always bails them out. But it's obvious. It bails them out because by doing so, it protects the natural currency and the money supply. Rogoff and Reinhard, in one of their articles, got themselves to the point to say that banking crises are an equal opportunity menace. They menace everyone, everywhere, at every time. So actually, what pushed me to write the book was the attempt to find out with a little degree of precision, and the attempt to tell how we got there, how we got to the stage in which the debts of banks are the currencies of nations. And I decided to organize the narrative on 7 episodes. Episodes based in the Republic of Pisa of the 14th century, Venice in the 16th, 17th century, Naples at about the same time, England and the Bank of England, the US Continental Congress, and Bolshevik Russia. All these cases, all these examples across different nations, different culture, different political economic organization, and across about 600 centuries, exhibit the same they have the same feature. They look at how the debts of banks became the currency of this nation. And you all are interested in this issue, and so you will also be interested in the approach I took, which is rather different. I decided to try to find out how this happened by looking at transaction. You might find the book a little boring even when you read it, because actually the book is based on an analysis of real transactions between different states and different type of banks and of banking system. Why did I decide to use an approach that is that is so new and that is so atypical? For 2 reasons. The same is general, and the second is personal. The one is general is because I believe that transactions do not lie. If you understand them and if you disassemble transaction, you can get to identify very clearly the goal of the partners and how they went about achieving as much as possible of this goal. And the personal reason is that I've been doing transactions for most of my working life for different subjects, and so transaction is what I do, and I believe that I understand them somewhat, maybe not totally, because some of them get exceedingly complex and exceedingly technical, but I believe that I understand, I can disassemble most of them, if not all of them. So this is the origins of the book, and what the book point of view is. Why did I start in Pisa? I started in Pisa for 3 different reasons. The first one is that the Republic of Pisa, that was very strong between the year 1000, maybe 900, and the 1380, 1390, Pisa was also the place where Fibonacci was born, and where his masterpiece, Liber Abaci, was written and I would say published, even if it was not pressed in 1202. You know, Fibonacci Liber Abaci is a strange book. When a mathematician looks at Liber Abaci, he sees one of the foundations of modern mathematics, because Fibonacci had been in the Eastern Mediterranean a lot, and he had learned Indian and Arab mathematics together with the European and the Western one, and blended them together. And so mathematicians see in Liber Abaci the foundation of modern mathematics. Now, financiers and economists and bankers have a totally different approach. They see it as a manual for bankers, because all the examples that Fibonacci uses to describe some of his new mathematical concepts are actually examples in finance. For instance, Fibonacci is one of the, in Fibonacci, you will see one of the first detailed description of how you calculate the present value of future cash flow in different currencies. And so while the mathematicians see a book of mathematics, we bankers see a book of finance. And I would say that the people around Fibonacci tended to see it as we see it, as a book about finance. And in fact, they started establishing a school of Abaci in all the Italian republics, in France and everywhere else. And the school of Abaci, students learn how to do financial mathematics and how to analyze financial transactions. Actually, my friend Will Grossman of Yale calls it as a manual for aspiring bankers. So that's the first reason to start in Pisa. The second reason is that there was one bank in Pisa that kept a very nice, very detailed ledger of the banking transaction. And oddly enough, this ledger has survived. And one of the interesting things about this ledger, and you have to understand that I know very little about accounting, but one of the things that I find so amazing about this ledger is that the fact that they were not using double entry bookkeeping, but they were just overlapping the debts one over the other, and so it was possible to clear them much easier, clearly shows what banking was all about in the Republic of Pisa. And what's banking all about? Banking was simply the translation of the debt of client into the debt of the banker. And this worked because the debt of the bankers were accepted in Pisa as much as the gold and silver coins for the public mint. And so Pisa was one of the first nation states that was working with actually two currencies. One was the coins that were meeting at the public mint, and the second were the debts of a large group of private bankers that were actually creating money, like more or less to the same extent that the public mint was doing. And so de facto, there were two entities, the two entities creating money in the Republic of Pisa. One were the elected officials, because in Pisa the officials were elected by a reasonably large sector of the population, and the second were the bankers. And so this small, tiny republic was one of the first examples of a city-state, of a state working with two money, coins from the mint and debts for the private banks. Then I decided to move from Pisa to Venice. Why moving to Venice? There are several reasons. The first one is that the Venice Republic lasted for about 1,000 years. 1,000 very difficult years. Venice was at war with much more powerful enemies for almost its whole existence. And it was a tiny, tiny city-state. Yet she was able to survive warring for 1,000 years and keeping much more powerful enemies at bay. And I honestly think that one of the reasons why Venice was able to do it was for some very peculiar features. And one of these peculiar features was the ability of the leadership of Venice to use financial innovation for the interest and the defense of the state. See, this is a very peculiar situation, because since 1297, Venice had been a close oligarchy of wealth. The elected officials were elected among a reasonably close group of very wealthy people. But these wealthy people were able in some way to balance the public interest with their own individual interest. And by doing so, they were able to make their own family, if you want, by also the Republic, survive from the 900 to 1797 until Napoleon conquered the Republic of Venice and put an end to its long history. And they did it by a lot by financial innovation. Very creative financial innovation. And this financial innovation was mostly on two areas that you will find very interesting. The first was public debt. Now, Venice was one of the first states to have long-term, almost perpetual public debt, widely distributed among the citizen and among foreigners. If you look at this public debt had a very peculiar feature. This debt was mandatory debt. That is, they were not voluntary loans by investor, but what Venice did was they ran a service of the ownership and the wealth and the networks of the citizen, and they imposed a tax on this citizen. But this was not really a tax, because it was actually a debt certificate that let's call it the taxpayers, the people that had to pay it, could sell on the secondary market. And so instead of being taxed, these wealthy citizens of Venice, they got an asset that they could sell on the public market if they needed cash, and they got a long stream of cash flow. And so the essence or the survival of Venice and the wealth of Venice had been based on public debt and public debt financed in this way, raised in this way for a long time. And at one point, in a particularly difficult time, Venice realized that this reliance on public debt and this ability to raise public debt was giving them a great opportunity, was giving them, and their knowledge of financial technology was giving them a great opportunity. And it was the opportunity to turn this public debt into purchasing power through a bank. And so the Republic of Bank established a public bank that is a bank owned by the state, in which all the assets were public debt and the liabilities were money. And the state was the first one to use the debt of the banks. And after the debt of the banks, of course, were received by by everyone in the city, and they became money. I know that sounds arcane at this point, and so let me try to give you an example. There was a public office in charge of feeding the city. This public office was buying wheat around the Mediterranean. And so at one point, the public office needed to buy wheat to distribute to the citizen in a very difficult moment. And but they didn't have any coins. And so the way the bank was organized was that the treasury promised to buy the bank, promised to pay the bank for the benefit of the office that was going to buy the grain. The office of the office promised to pay the bank, and the bank promised to pay the seller of grain. In this way, the promise of the treasury had been converted into purchasing power for the grain office that was able to purchase wheat and distribute it to the city. And this new type of bank, which is the first bank I know of that worked in this way, survived from 1619 to 1797, and for the last 150 years of the Republic of Venice was the only bank in the Republic of Venice. And so Venice again functioned with two different kinds of money: coins from the public mint and promises to pay debts from the public bank. The Bank of England, actually the foundation of the Bank of England was motivated by the same need that the Republic of Venice saw. In a particularly difficult moment, the new Parliament of Great Britain in 1694 wanted to create a bank that could turn public debt into money, into purchasing power for the government itself. And they did it in a reasonably different form from the Republic of Venice. First, instead of having a bank that was an arm of the state, they chartered a private corporation. The private corporation did two things. One, it sold equity for coins, and two, it lent all its capital to the state, to the treasury, to the exchequer. But it did not loan the coins it did not loan the coins that were in the coffers. What they lent was debt of the banks, a particular kind of banknotes. Now, what I find, but maybe if you want, if not, we only speak about the Bank of England and the peculiarity of the English system that I found exceedingly interesting. But if not, it will really take too much time to go through it. But I think that the solution of the Bank of England was very creative, and nobody thought that the Bank of England was going to survive. But the Bank of England survived and prospered and became one of the most cherished example of central bank. I have done a lot of research at the Bank of England, and I think I had been able to reconstruct the first trade ever made between the Exchequer and the Bank of England. And it is complex, but if someone wants to know it in the detail, in the question and answer question, I will be happy. I will be happy to describe it, and you will find exceedingly interesting. Now, the fourth chapter is on the Bank of Naples. I know Naples sounds like an odd place to go for financial innovation and banking innovation, but actually Naples had been able to create a banking system that was totally unique and totally atypical. Naples, from the, let's say, late 15th century until the late 19th century, had one peculiar type of banks. They were not for-profit corporations, they were charities. The idea of a charitable institution that gets involved into what looks like a totally uncharitable type of business, lending money for profit, it's atypical, but the Venetian system was able to do it. In Italy, there was at the time, and there still is, a long tradition of banks that are the offshore of charities. They were actually the invention of the Franciscan order at the end of the 15th century. And they were called Mounds of Compassion, because what happened was that the PUs were donating coins to this charitable organization. The organization were piling them up into mounds, and after they were lending them to the needy for free. Now, from this reality, the banks, not only on Naples, but the Bank of Naples were the first one, they realized that this reserve of coins was giving them the opportunity of developing a banking system, and that they could use the profit that they made with doing a banking business. They could use them to support good causes, to do good to society and to the states. This bank were also able to create a very peculiar type of bank money. This bank money was a written first and typed after pledge by the bank to keep a client as creditor. And these peculiar certificates of debt by the bank did circulate reasonably well, but they needed to be accepted in writing by both parties. And this acceptance in practice made this type of bank money a little slow, but reasonably safe. And so everybody in the Kingdom of Naples had a lot of faith in bank money, and bank money very soon almost supplanted completely the coins from the mint. From 1507 to 1710, 1712, the Kingdom of Naples was actually a province of the Spanish Empire. And the Spanish Empire saw immediately the opportunities that were offered by this banking system. And actually, they found a way to exploit this sophisticated banking system to finance the expansion and the war of the Spanish Empire. And so we had this strange situation in which these exceedingly creative charities that had found a way to do banking without profiting from it, or at least without pocketing the profits, at the end supported the Spanish Empire. And I think that this is an exceedingly interesting example of financial and banking innovation, and is an example that is in particular worth studying it for one reason, which you will find peculiar. Since all these pledges of credit that were circulated had to be deposited to be credited on the accounts of the customer, many of these pledges still exist. While if you go to the Bank of England, you will find, I have been there, if you go to the Museum of the Bank of England, you will find probably 10 at the most of the original banknotes of the Bank of England that had been distributed. If you go to the archive of this Neapolitan bank, you will find 250 rooms full of pledges of credit named, and so you will know who got the pledge and who accepted it. And not only they are all there neatly stacked, but they are also the details of the reason why these pledges were issued are in the ledgers. And so you will have a very detailed ideas of how the banking system, but not only banking system, the society and the economy of Naples and of part of the Southern Mediterranean and the European side of the banking of the Spanish Empire world. And so it should be really worth a lot. It should be really worth a lot of research. And now, since we run the risk of running out of time, let me move to the US. Let me skip the financing of the Spanish Empire for a while, and let me move to the US. What I found, I lived a fair amount of time in the US, but I still I'm not an American. What I found exceedingly interesting researching the birth of the United States from the banking point of view is that, and especially looking at the Continental Congress, is the fact that I notice in the colonial period and in the period of the Continental Congress, I noticed a very clear plan to make of the US dollar that they were creating the attempt to build a national currency made only of debts. And the colonies and the United States were forced to get to this very innovative kind of currency because, for a lot of reasons that we can discuss, there was scarcity of coins in the North American colonies because the British Empire didn't give the colonies the right to mint. And so the colonies could not mint. And when they rebelled, they found themselves in the need to fight the British without having either their own currency or their own mint. And so they developed a currency made only of debt. First, a currency made of debt issued by the Continental Congress itself, the famous or infamous Continental, that was issued in huge quantities, and that was issued in huge quantity and depreciated very, very quickly. But after they quickly catched up and realized that if they were able to transform the public debt into bank debt through the establishment of a national bank, they will have had a currency made only of bank debts. And if the debt was well structured, these bank debt will have had the same purchasing power of gold or silver coin, especially Spanish silver coin. And that was exactly what we did. And one of the things that I found amazing, and I recommend all of you, or those that have not done it, to study this particular period, is because of all the research that I have done. In this particular period, you find some of the most interesting characters in modern public banking. I know the United States is supposed to be, it is the there's a birthplace of free banking, but some of the characters that were involved in creating the American public banking system were really incredible. And I'm not referring to Alexander Hamilton, that now is also the star of a very famous musical. But I'm referring about some people that have a bad reputation and that might be, as character, might also be debatable, like Robert Morris, the superintendent of finance, a speculator and a slave owner, but a man of an incredible financial creativity, an incredible determination to create a currency made only of debts in the interest of the United States, that I found in him and Governor Morris, his deputy, I find really incredible, and I have not seen in the other examples and the other instances that I have mentioned to you. I haven't seen them in Pisa, I haven't seen them in Venice, I have not seen them in Naples, I haven't seen them in England. But here, these characters and their determination to create a currency made of debt, where the asset of the bank is just the public debt of the Continental Congress, I found it just amazing. So in the order, since I want to give as much time to you, to your question as possible, and I've taken too much of your time, let me speak briefly about the Bolshevik experiment. And I will start with a brief personal history. In 1990, when the Soviet Union was in its death throes, I was sent to Moscow to close a deal. The deal that I was sent to close was the privatization of the Soviet Union largest car company through a sale of 50% of its equity to Fiat. It has agreed between the chairman of the board of Fiat and Mr. Gorbachev. The deal has been agreed, the price has been set, and all the terms. There was a very detailed letter of intent. All I had to do was to close the deal and to arrive at a transaction that could be implemented. When I got there, I didn't speak Russian. I didn't understand anything about the Soviet Union. It was my first time on the other side of the Iron Curtain, and so I had to find a mentor. And I find a mentor in a very exceptional person, Vladimir Yakovlev, who was the editor of Kommersant, the new Russia version of The Economist. And Yakovlev told me that in order to understand the Russian economy, Russian finance, and the Russian monetary system, I have to think that in Russia, since the Bolshevik Revolution, there had been not one, but two different economic and financial systems. And with the true Russian fashion, they all took their name for one landmark in Moscow. The first one was the Red Square economy. This was the economy of the state-owned enterprises run by the state according to the rule and the procedure established by the party, by the Central Committee of the Communist Party. The second was the Sukharevka economy. Sukharevka is the old open-air market in Moscow in which you can buy anything and everything for cash. And the Sukharevka economy and the Red Square have survived and are still surviving and prospering side by side to an incredible degree. And actually, the Bolshevik banking system and the Bolshevik monetary system was designed in such a way to be able to accommodate both the needs of the Red Square economy and the Sukharevka economy. And trust me, that was unfortunately for me, that was not only my not my only experience in Russia. I was also there for 3 years, heading the Goldman Sachs office in Moscow until the invasion of Crimea, where we left Russia. And I can tell you, until 2015, when I left, Sukharevka and Red Square economy were still living side by side, and I'm sure they still are today. Okay, that's my speech. Over to the audience.
Go ahead, Paul.
Oh, I could listen to this for hours.
You're too kind. You're too kind. You're too kind.
No, we're junkies. That's the problem.
Yeah.
All right.
So am I. So am I. Less kind, but deep junkie.
Well, I'm gonna. David gave me the opportunity.
We're having trouble hearing you, Paul.
Okay. Yeah.
So we're still having a little trouble there, Paul.
Yeah.
So
You don't come through.
yeah, so I'll start with the first question. Then we've got a fair number coming in from the audience, and then thank you very much. This is not boring at all. In fact, the book is very rich in storytelling, as I said earlier, and you've told lots of good stories right here. And they do want to hear about that story about the first trade between the Bank of England and the Exchequer. Could you please share what you learned? And that's from Pranay Adutha.
Okay, yeah, I'm glad you do it. See, what I found so peculiar about the English example is that for 600 years, probably more, the only public debt security in England was a stick, a piece of wood. And the way it worked was the following. When taxes in England were, of course, collected by some tax collectors, they collected the coins from the taxpayers, then they went to the Exchequer and they deposited the coins. In the moment in which they deposited the coins, an official at the Exchequer took a tablet, a small tablet, on both sides wrote the amount of money that had been deposited and or consigned, and the name of the tax collector that consigned the money, and then it cut the figure, the amount of money that they have, that the tax collector had consigned on both sides of the tablet, then split it in half. Half went to the tax collector and half remained to the Exchequer. At the end of the process, the Exchequer audited the process because they wanted to make sure that the tax collector had not pocketed some of the money for themselves. And so they called all the tax collector. The tax collector came with their half of the stick and joined it with the half that had remained with the Exchequer. And in this way, they knew that everything had been done well and nobody has pocketed any money. And so the part of the stick that was in the hand of the Exchequer was actually the best title of public debt, and it was used in Great Britain from the 11th or 1200s until to the early 19th century. And the trade with the Bank of England was the consignment of the Exchequer of 5 tallies for 120,000 euros in exchange, British pounds, in exchange for the same figure in banknotes. And so it's I found it amazing that the best and the most sophisticated central bank in the world and one of the most sophisticated financial system actually for 600 years was based on 6 liter.
Thanks, Paul. Are you good? Do we know? So no, unfortunately, maybe you'll maybe drop off and then work with Brand Live offline. So Jacob Cowan wants to know, is that the sticks on the cover of the book?
Yeah, those are some of the sticks. Yeah, some of the sticks. Actually, if you want to know a little story in order to be light, when I reconstructed the transaction, I thought I reconstructed the transaction from the archives of the Bank of England. I wrote to the Museum of the Bank of England. And I said, do you happen to have some of those sticks? And maybe they don't like the answer, but They don't like me telling it, but it's the absolute truth. And they wrote me back saying, we are embarrassed to say that we have some of these things, but we put them away during Hitler's Blitz in 1940, and we have not taken them out of the case yet. If you come, we will take them out together. And I went to the Bank of England. They were extremely kind. I went to the museum. We went downstairs in the vaults and we opened up the case. And believe it or not, 3 of those, I think 3 or 4, I don't remember now, relates to the first transaction, the one that I described, the one of the £120,000. And since that has never been reimbursed, you talk about permanent public debt. The original debt of the Bank of England has never been reimbursed by the Exchequer to the bank, and the debt instrument that we're giving as collateral, 4 of them are still there.
Great.
Isn't it amazing? And they are sticks.
Great. I see Professor Jim Kelly's joined us. Thanks, Jim, to pinch it. So let me just ask one more.
Here's a question.
Yeah. Go ahead, Jim.
Okay, here's a question from Will Snodgrass. What were the interest rates of the early banks, Madison, England, etc.? What interest rates do they charge?
So, Pisa, now, let's take it. The Banco Giro, given that it was only an institution that had to turn public debt into money for the benefit of public office, did it for free. Okay? So that was just the creation of money. That was just, it gave it for free. It didn't loan, it did not loan. It transformed the debt of the public debt, it transformed into purchasing power that was put to the service of of departments of the Republic of Venice. In the case of Pisa, which I found one of the most interesting, and I will tell you why in a second, the private bankers were charging between 8 and 13%. And they were so sophisticated, the banking technology and the banking technique was so sophisticated, and the dearth of coin was so massive that there were some companies that had the bank being their treasurer. So they were not collecting coins, they were not collecting cash, let's say, but everything was done through the bank. And so the bank was actually the treasurer and the financier of the company, and everything was done on the ledger of the bank just by crossing credit and debts. And they were also paying the workers in this way, because the use of bank money was so widespread that and there were no banknotes. But Pisa was very small, and so everything could be done just by going to the bank and doing it in person. Everything was done on the ledger, and the ledger of the bank was actually the treasurer and the financial officer of the entrepreneur. And these very large clothes manufacturer that I have looked at, his cost of borrowing was about 13% per year.
One thing I would or two things I'd add for Will Snodgrass, who asked that question, is Scylla and Homer have written a book called, it's 4th edition now, I believe, History of Interest Rates, and you might want to check that out. And also, this lecture series 3 years ago, we had Paul Schmeising from Yale, who looked at interest rates from 1400 on, so as a follow-on. All right, something lighter from our friend Miles Thompson here, more of a comment. Thank you for such beautiful and significant work. Now that you have been called the Indiana Jones of banking, do you need to change your wardrobe?
No, that's Indiana Jones of Bank. Yeah, that was fun. That was fun.
Keep it in the archives.
Yeah.
For sure. Jim, go ahead.
There's a question from Ed Fraser. How does the occurrence of negative interest rates fit into the picture? Currently, we've experienced in recent years.
It doesn't. You know, I really didn't look about interest rate. I just look mostly at, I just look at these and a few others and a few other instances but I didn't look at interest rates.
One story that stuck with me was when the Bolsheviks took over the state bank, and a little bit of craziness at first because they didn't want to attack. Can you just tell that story? They didn't want to go after the other workers
Yeah, I can tell you. That's a nice story. I also liked it. And I think is an example of all the craziness that went through the Bolshevik system. So Lenin had studied banks very closely, both on books and personally very close when he lived in Geneva and in Zurich. So Lenin understood about banks in society. And he was convinced that bank can be, for him and for the Bolshevik, banking could be an incredible, one of the strongest enemy, or one of the strongest allied in making the Bolshevik system succeed. So the first thing he did when the Soviets, the armed Soviets, moved to occupy the Winter Palace, some of them moved to occupy the Winter Palace, and one group was sent by Lenin himself to occupy the state bank. Right, first, the Winter Palace on one side, and so the seat of the executive power, and number two, the central bank. So he considered these the two places he had to get control. So he sent a very weird gentleman saying, you take control of the central bank, and you come back with the control of the bank and 10 million rubles in cash. So the guy put together his armed group, went in and ordered the senior manager to put all the bank at his disposal and give him the 10 million rubles. And the guy said, "We go on strike." And this was Bolshevism. And so the armed group that has been able to took over the bank, they thought that being true first Bolsheviks of the first hour, they could not even force someone that was on strike to do something. And so they did not take over the bank. And so they went back to Lenin and said, "What do we do?" And so, do you know what they did? They changed the director of the bank immediately with a decree. The new director didn't get on strike, and Lenin got control of the bank. It's a true story.
Good stuff.
But the real interesting part is, why did Lenin think that the bank was important in getting communism in Russia? He thought it was important because the bank was having control of the bank was the only way to make money money in the sense of means of payment, disappear. Because he said, if I make the bank strong enough, there is no need to pay for purchases, because an all-powerful bank can cross and compensate debt and credits on his ledger for everyone. And so we don't need means of payment. Nobody will need means of payment. And so he thought that actually the banks were the best state structure to have, first, total control, and second, to have true communism, if you can realize a system in which debt and credits are all crossed with thousands and thousands and thousands of bank ledgers. Interesting. We never see this side of Yeni. Never see it. I didn't have a clue that was a master plan. But afterward, everything checks.
Follow the money.
Yeah. In this case, follow the ledger.
Follow the ledger. Jim, why don't you close us for the season? You know.
Okay, I guess, well, just, thank you so much, Paolo, for sharing your knowledge and your experience, firsthand experience in Russia, for example, with us all today. And this completes the last in our series of webinars for the academic year. We'll take a little break and be back with a whole new series in the fall. Thank you all for joining us.
Thank you.
Thank you, all of you, and thank you for having me. I really enjoyed it. Thank you.
Got lots of good summer reading, including Paolo's book.
Yes, okay.
Thank you.